You're listening to Flip Empire, the show committed to helping real estate entrepreneurs who want to build their empire without sacrificing their life. Your success and freedom starts now with your host, Alex Pardo.
What is going on? Do I have an incredible masterclass podcast episode for you with my good friend Anna Kelley, who is a 4-time Amazon bestseller. She is a speaker. She's a multifamily syndicator. She is a ninja when it comes to creative financing and short-term vacation rentals. And that's actually a great jump-off point for what you're about to learn and hear on today's masterclass here on the Flip Empire Show. I've actually had the privilege of interviewing Anna in a previous episode on 228. So make sure you check that out in the show notes. And on today's podcast episode, we're going to focus on her transition from multifamily, and actually not even a transition because she's still an active multifamily syndicator, but she's added 11 short-term vacation rentals to her portfolio, many of which are trophy assets, assets that have things that you're about to learn, that are very unique in some way, shape, or form because they're oceanfront or because they have a particular view. So I asked her a lot of questions about vacation rentals, which is a topic I haven't really dove into too much here on the Flip Empire Show. And because of some of the requests that have come in, Anna was one of the first people I thought of when it comes to short-term vacation rentals. And I really in particular enjoy her approach because it's very lifestyle driven. Yes, she outlines kind of her checklist, things that the process she goes through as a smart and as a wise investor to determine, is this a good asset? How do I determine not only the asset class, but the type of asset I want in which market? But it's also very lifestyle driven, which, as you know, resonates with me. She also, really just kind of outlines her thought process and the psychology behind analyzing and evaluating risk with your real estate investment decisions. And if you just heard the 3 to 5, 6 minutes that she just shared on that, it's just extremely valuable. This is one of those podcasts that, as you're about to hear, I'm going to encourage you to listen to numerous times because it's just packed with so much wisdom. And with that being said, I want to go ahead and introduce you to my friend, Anna Kelley. Welcome, everyone. My name is Alex Pardo. I'm the host of the Flip Empire Show, and I am super pumped and excited, as always, to come at you with episode 660 with my good friend, Anna Kelley. And before I introduce her to you, I want to just point your attention to the show notes because back on episode 282, which is just, it blows my mind how many episodes ago I had Anna on, and I remember getting so much positive feedback from that episode. So I definitely want to, make sure that you guys check out that episode because Anna's always someone that, whether it's on her Facebook post, through her coaching program, just the content that she puts out on different podcasts, she is always providing just an excess of value relative to the time that she's putting in. So it's incredible. She's definitely one of the thought leaders in our space and somebody I highly trust and respect. So with that being said, Anna, it's awesome to have you back on the show for a second time.
Thank you so much. It's really my honor to be here. I so enjoyed our conversation on that episode, just sharing our wisdom about the economy and our faith and, just the things that drive our lives. And it was really impactful for me as well. So I'm so blessed and thankful to be back on your amazing show.
Thank you. I'm excited to get into this. And, I'm going to focus on the gain and not the gap because I wish we had more time together. 45 minutes, maybe an hour max is not a whole lot of time to get into. There's so many things that I think you provide an expertise on, right? And you touched on some of those. I think at some point we'll definitely get into your thoughts on the market, how the listener, right, our audience, how real estate investors can position themselves in their business moving forward. But one thing that we were talking about offline, Anna, is Airbnbs. When we had you on the show, I don't think that was a part of your portfolio. And just from following you on social media, I know that you've made it a bigger part of your portfolio now. So why don't we kind of use that as a jumping off point? And it's interesting timing because one of your recent Facebook posts was talking about kind of staying calm in the midst of things that we can't control. Yes. Obviously, hurricane's about to hit Tampa in the next day or so. And I know you have properties on the water. And so why don't we just start kind of with what made you decide to get into Airbnbs? Because multifamily has been such a big focus of yours for the last several years. And when I started seeing that you were looking at Airbnbs, I was curious why you decided to, put that into your portfolio.
Sure, that's a great question. And, when I bought my first short-term rental, I bought it really because at that time, my husband and I had worked 70 to 80 hours a week for almost a decade, and we really were not enjoying life. We were building wealth, but we kind of became a slave to the pursuit of the financial freedom and getting me home with my kids, right? For all good reasons, but we didn't slow down and we didn't take vacations other than to visit my family in Texas. And I said, we have to start making ourselves make memories with our family and take time out to really live instead of waiting until we've achieved that number to get me home. We need to start really pouring into our family now because we don't know how much time we have left. So I decided to take a trip to Ocean City, Maryland, and was shocked, Alex, that it was going to cost me like $6,000 for a week at the beach. I grew up in the Gulf of Mexico, right outside of Galveston in Houston, Texas. We just drove an hour and we were at the water. And I couldn't believe how expensive it was. And a friend of mine who actually is a real estate investor owned a property in a really beautiful resort in Ocean City, Maryland. And one night on Facebook, he had a last minute post. We had just met and he said, $6,000 a week for $1,500 starting tomorrow. And I said to my husband, drop everything, cancel your patience. We're going to the beach, right?
I love it.
So we went. And so I said, how do you make this work? This $1 million home, it seems so risky to me. And he's like, you can totally own it, make a lot of money, have paid for vacations, and do the same thing financially that you're doing with your apartments, just with a lifestyle property. And so that kind of was like oh, wow, let's see how I can get free vacations. I wasn't really thinking about going all in vacation rentals. It was really a lifestyle play.
Okay.
But owning that property, I bought a property. It's been about 6 years ago since we bought our first one. I was able to buy it, basically a pre-foreclosure, and see how the numbers of consistent years of rental income covered the debt and would make me about $10,000 to $20,000 a year net, fully managed, but I'd have free vacations, 2 weeks of summer and a lot of time. So that was one of the best purchases we ever made, really, because it was about pouring into our family. Okay. The numbers were not phenomenal, compared to what I get now on a lot of other properties, but it was a choice to balance my lifestyle with a wise financial move instead of just having, a frivolous second home that we probably couldn't have afforded at that time. So I started a while back, but moving forward, as the market has started to change, we talked a little bit in our first episode about me living through 2008 and 9 and really being, almost wiped out and having to start over again. And I really made a concerted effort at that time that I had to start taking control of my own finances. I couldn't depend on, a job, a business, my 401k. I needed to figure out how to watch the economy and understand how big shifts in the economy could impact my wealth and my income. Yeah. And so I started to see at the end of 2008, around the time I was getting ready to retire from AIG, that interest rates were going up. There was kind of a taper tantrum in the markets. And we had a manufacturing recession in early 2019. And I thought early this could be the beginning of the end of the expansion, the longest expansion in history. Yeah. And I need to start diversifying because what I knew is that everything I owned to that point, which was primarily small multifamily properties, was in one area of central Pennsylvania. And it was in generally one asset class. I had a few single family homes as well, but I thought I need to start diversifying some of my portfolio into other markets and into other asset classes that can hedge a little bit of the risk that I had in the multifamily side. And at the same time, I was retiring from AIG in May of 2019, and we had not traveled other than our beach house. So I said to my family, we're going to cross country and we're going to start traveling at least 8 to 10 weeks of every summer and spring break and maybe the holidays. So we made a lifestyle choice to design our life by design, to buy properties that we wanted to go to every year, in Florida, in Pigeon Forge, Tennessee, down to, visit my family in Texas, where we could create that lifestyle, also create amazing returns and hedge a little bit the risk of having all multifamily and all in one market.
I have at least 4 or 5 questions bouncing around in my head, and there's a lot to unpack there. And but first, before I kind of dive into the first one, you and I have so much more in common than I even wonder if you're aware of, because we're both lifestyle driven. We're both people of faith, first and foremost. We have families. And I love listening to you speak because your thought process, I always pick a nugget out of the way you kind of think about things. And selfishly for me, I think I'm going to be learning just as much as I think people listening to this show, because my wife and I have always wanted a waterfront home in Key Largo, in the Keys, which is only about an hour away from us. And I've always been a little bit gun shy to pull the trigger for a few different reasons, which I think is going to be a pretty decent segue into my first question. You were a successful, or you still are a successful multifamily investor. Some might say, hey, getting into vacation rentals potentially could be a distraction for you. Why not double down on multifamily? You already answered it. You said, hey, I wanted to diversify the portfolio. Were you concerned at all about diverting some of your energy, attention, resources, and money from multifamily, which you have kind of wrapped your arms around? You're doing extremely well with that. And were you concerned about just now devoting some of that energy over to Airbnb, and how much time was this going to take? Talk to me a little bit about the mindset, and ultimately you decided to make that decision, but was that a concern of yours?
It was a little bit, right? I do tell people, and I have students, and I tell them, don't get squirrel syndrome and shiny object syndrome and jump from asset class to asset class in the main thing that you do, right? But starting out in private banking, I really had a very good foundation, in the late 90s, learning about how people grow wealth and how you keep wealth and how you grow your income. And so I really put on my investor hat before I put on my real estate operator hat, because they're two different things, right? One is, what is the main game I'm going to play for my way to continue to make income as a business? And for me, that's multifamily syndication, right? And that will probably always be my primary way of doing business, because I do believe in it, and it's recession resilience, inflation resilience, and all of that. But outside of what I do day to day, if you look at what wealthy people do, they take what they make from their day job, right? And they invest it into other things that they may or may not be somewhat active in or completely passive in. So when I started out, I didn't say, I'm going into the business of owning short-term rentals. I said, I want to own short-term rentals as an investment that also fuels the lifestyle that I want to live. And so as something that for me was playing a dual role, I really had to balance the fundamentals of the investment. Are they going to preserve my wealth? Are they going to go up in value? Are they going to create income that such that the risk of buying an expensive property is worth it? If a pandemic shuts it down, for example, or we go into a recession, with what do I want for my life, and balance that somewhat. So I made a decision early on, which I'm shifting a little bit, that these were going to be completely managed by professional property managers, because I needed my time freedom. And if I started the business of trying to self-manage all of them, I would give up, $10 or $20 an hour activities and not be able to spend my time on my $2,000 activities. And so I made the decision not to make it a major business that I had to chase after, create systems, create people. Over time, now that I have 11 short-term rentals at this point, it makes sense for me to automate some things. I have an assistant that does things for me. And my son, who's in Pensacola right now in college, he's excited to start his real estate venture, and he is managing one of the properties that we bought near him. We bought 2 beachfront by him in Pensacola, and that's kind of pouring into him and his legacy, teaching him the systems so that he can then manage them, save me a little bit money. But yes, in a nutshell, I didn't create a whole new business. It can become that, but I didn't have time for that. And it wasn't the wise move for me to make. It was purely an investment and a lifestyle choice.
Understood. And I'm also hearing a lot of, I've referenced on several podcasts over the last several months, the book Who Not How by Benjamin Hardy, and Dan Sullivan has had a big impact on me. And now I'm constantly asking myself, this is a who, this is not necessarily a how type question to answer. And I found that you found your who. Whether it's your son who's managing a property, whether it's a professional management company, your assistant. So who is embedded in all of that? And I just wanted to highlight that. Some follow-up questions as it relates to the Airbnb. What I heard you say, Anna, was that you based a lot of your investment decisions based on lifestyle, right? Like, where do we like to travel? What are some of the things we like to do? What other aspects of the checklist needed to be marked off for you to say, hey, this is a market I want to enter, or this is the type of property I want to pursue?
Absolutely. That's an amazing question. And it's really important too, right? We can't just say, I want to travel there, so the wise thing is to buy the property. In some situations, when you want to create lifestyle, it's cheaper to rent the experience than it is to buy the experience without the risk, right? So one of the things that I do, I love to shop, but I love to shop properties, right? But I'm always looking at the price tag. Is it worth me paying this amount of money for the property, and what kind of reward am I going to get out of it? And I realize that over time, I may not be able to travel as much. My kids have games, they have sports, they get older, they don't want to travel with mom and dad all summer, right? So this could be a limited opportunity for me to own some things for 6 or 7 years before my kids are out of the house. And maybe at some point I sell. So I'm still going back to the market fundamentals of saying, of the markets that we'd like to potentially travel to, of the areas we drive to every year as I head to Texas to see my family, which one's actually a really strong short rental market? So that's one of them. Historically strong, right? So I'm looking in areas that are not just, they've popped up in the last couple of years, people are making a killing, but oceanfront properties, right by national parks in Pigeon Forge, Tennessee, for example, where there is a proven history of decades of families coming to vacation in those spots because it's a place that people want to be. So proven demand locations and the types of properties that I know people are going to rent in good times and in bad. They have some recession resilience built in, and they had to be profitable areas, lower taxes, lower insurance. Now, my ocean fronts in Florida are an exception to that, right? Because I want to live there when I retire in the winters, and my son and the rest of my children will probably go to school in Pensacola. So those have a little more operating expenses, a little less profitability. But what I did is I took that as a whole and I invested in a subscription to AirDNA. AirDNA is a website that basically I can look at what are people actually listing their properties for to rent. How many days are actually booked? What is the average annual income that people actually brought in on those properties? And then there's a report put out every year by a company called rented.com. And it's also very high level. And what they do every year is they look at the prior year, comparing apples to apples homes. And they say, where is it the most profitable places to own short-term rentals in the entire country? And so I look at that report every year. Well, it just happened to be, Alex, that over the last 2 or 3 years, the Smoky Mountains and Pensacola, Florida, have been in the top 10 of the most profitable places to own vacation rentals. So I said, listen, my son's in Florida. We drive through Tennessee halfway on the way to stop in Florida. We have to stay in hotels all the time. It's profitable. Why not try to buy one in those areas because they're profitable and it fits my lifestyle? And the two of those things had to go together.
Phenomenal resources. I so appreciate you sharing those. So airdna.com is one. And then you said rented.com is where you look at this annual report?
Yes.
Okay. Fantastic. How do you balance or weigh a place like Pigeon Forge, which, by the way, my family and I go to Gatlinburg probably every 3 to 4 years. We love it. We've been multiple times, and Pigeon Forge is not too far from that area. How do you weigh a place like that where you know there's a ton of demand for short-term vacation rentals versus the supply? There's so many properties out there that are on Airbnb and VRBO.com. What kind of metrics are you looking at to say, hey, there's a lot of supply here, but the demand outweighs that?
Yeah, great questions, Alex. And this is another really important one. And one of the things that I learned really from an agent that I was working with as I took 9 months to research before I bought that first property in Ocean City, Maryland, is that when you're in a market that has a lot of rentals, you really have to pick the property that has that unique value proposition that not everybody else has, right? And so, for example, if there's a recession and people are going to not travel quite as much and there's lots of opportunities, the people that are traveling want the best of the best. If they're going to spend $5,000, and maybe now they have to spend $4,000, they still want the best of that opportunity for that money. And so I'm buying properties. I'll give you an example. In beach areas, you want the oceanfront properties because the people that are hurt less by a recession are still going to pay to be on the ocean. They don't want to be a couple buildings back and see a peak. They don't want to walk. If they can afford it, they want the ocean front. They want it to have all the amenities. They want it to be decorated in a modern and clean and beachy feel. They want to feel like it's a retreat, right? I have a lakefront property that I bought. My unique value proposition, why I bought this property, it's one of the only houses actually with a lake view at the top of this mountain, and it's 2 roads off the boat launch. Well, every other property in that area is not on a mountain ridge and not on the lake because it's federal game land. So I have this very unique view that no one else can ever duplicate because it's federal game land. I'm really close to the water. But the other thing that I realized is that most mountain properties are lodgy. They're dark. They feel musty just looking at the pictures, right? And I said, I don't want to go to a musty, dark man cave, right? If I'm going to go to the lake or to the cabin, like I want it to feel relaxing, right? I can see animals and I can see, pictures of nature, but I want it to feel light and vibrant and happy. So we decorated our property lakey instead of lodgy. Why? Because women are the ones booking the trips, not the men.
Such a good tip.
Women are not going to go for the dark, rustic, lodgy place when their husband wants to go hunting and they're stuck up on the mountain and the lake in the fall. They're going to go, I want to feel like a spa. My husband can go hunt and I can just relax, right? So those are the kind of things that I do is the properties that have the best views, the best locations, the best decor, and are a little bit different than what everybody else is offering. And that means you're going to pay more for the property, right? There is some risk there that you have higher debt service, you have higher payments. And if travel is shut down, like it was for me in the pandemic, some people may not come, right? But the trade-off is when it is doing well, or if there's a recession, if you can cater to higher end families that can afford it and will continue to travel, you'll just do better overall over the long term.
Anna, to that end, would you advise or recommend, and this is probably the classic answer, it depends, right? Because everybody's situation is different. But generally speaking, would you advise somebody against purchasing a jewel type, trophy asset like you're speaking that has something unique about it, like, your mountain home that you just discussed, only if they can afford it with the income that the short-term rental brings in? In other words, let me rephrase it for maybe somebody, because I don't think I did a great job of asking the question. If somebody can only afford the asset with the income that's generated from the short-term rental, would you advise they still move forward if they found a good property? Or would you say, hey, only do it because if there's a pandemic that shuts down, I can still service the debt, even though I might be shut down for half the year or whatever? I'm curious kind of your thought process there.
Absolutely. Especially in this market, there's a lot of things that have shifted just in the last couple of months where, before I could get 30-year fixed interest debt, sub 4%. And I have that on almost all of my properties, right?
Amazing.
So my debt service was very, very low, even though my prices were ticking up because of when I was buying the property. But like my lake house, for example, I didn't buy that alone. It was $1 million home. And it was an unproven market really close to me that was starting to really build up. There had been families going for decades, but not at the price point that we knew we were going to have to ask to make it work. So I partnered with another couple. Both of us have the wherewithal that even if we never, ever rented it out, we could both afford to cover our piece of that debt. And so by partnering, I de-risked the amount of money I would have out of pocket every single month if for some reason they shut down short-term rentals or I couldn't put a long-term tenant in it. And so you've got to figure out always, can you afford to buy this? And in our last several years of economic volatility, there could still be some pain ahead, right? And so I bought everything I did knowing that I could afford with all my other income from my other properties, right, to cover the debt and at least put a long-term tenant in it. Okay. So I figured out what's the market value for a long-term tenant that wants to live here. And if I can get that amount and still cover the debt with my other, income, then I'm pretty comfortable.
Yeah.
The more historical renters there are, meaning Pigeon Forge, Destin, Florida, if people have been going there for decades, we know that it will continue as a long-term good investment for decades more, but we have to be able to weather these short-term blips in the economy, just like you would, if you have a house that you're flipping and suddenly you can't sell it, you put a tenant in it,
That's right. That's right. Yeah. I'm so glad to hear you kind of clarify or expand upon your thought process there. And the reason I ask is it always stuck with me. Many years ago, a mentor of mine, Anna, told me, he said, make sure that your dream vacation home doesn't quickly become a nightmare. Absolutely. And to elaborate, and he was coming from his experience. He ended up buying a $3 or $4 million mansion cabin in the mountains, and he and his family got a lot of use out of it for a year. And then his family and his wife wanted to travel elsewhere, and he felt always an obligation to go back to that place because of the debt service. And then so he started renting it, but he was bleeding a lot of money, and he ended up selling that property at a loss. Now, there's a lot of things that admittedly, he says he could have done differently, and he's learned a lot from that. But his point always resonated. Make sure that your dream vacation scenario doesn't become your nightmare. So that was really the encouragement, the motivation for wanting to ask you that question, because my wife and I have looked at beachfront houses in the Keys that have a price tag of $3-4 million. We've had to have honest conversations and say, hey, if we can't get short-term rental income, like, this is going to put us in a really, really tight spot. And I don't want to be there. Like, right. I want, one of the things that I do that I think you'll resonate with is I always ask questions. Does this get me closer to my vision, or does it take me further away from it? And as much as I want the sandy beach in my backyard and to go there, a couple times a month, we have to be realistic and say, hey, we're not there yet, right? Yes. Where we can just comfortably service the debt if I didn't have any income coming in from it.
So wise. And I do the same thing, really. I haven't bought a home over $1 million. When I say higher end, $1 million in a market that mostly has $400,000, $500,000, $600,000 homes and condos is about the threshold that I knew I could comfortably service all of that debt. I go and I see these beautiful $2 or $3 million homes. Have I been tempted to buy them? No. And you know why? I'd rather have a place that I know is a good, solid investment, kind of an upper middle target, but not the highest end, where even if I never go because my kids don't want to go there anymore, whatever it is, it's at least servicing the debt, and it's a preservation of capital play, in an area that the values aren't going to go down significantly, and it's paying down the mortgage. I have tax benefits, et cetera. So for example, when I went to Pigeon Forge, I have a lot of friends and actually even clients who've bought $1 million to $1.5 million big cabins up in the mountain. Mm-hmm. And I said, well, what happens if people can't afford to come? Are they going to buy the ones that are 30 minutes out and $1 million, $2 million, $3 million homes? Yeah. Or are they going to say, I want to be as close to everything in Pigeon Forge and Gatlinburg as possible, but I want to feel like I'm kind of in the mountains? And so what I did is I bought a property. I think I paid $525 for the cabin, 2-bedroom with a loft, 2 sleeper sofas, but it's a mile from the main exit to Dollywood. Amazing. And so it feels like it's in the woods. It's surrounded by trees, but it's really close to everything. Yeah. And I didn't buy the $1 million home. I bought the $525,000 home. It makes a 20% cash on cash return when I average 3 years of income. And that's an important piece. Don't look at 1 year of income and think it's forever. Average a few. And I said, that's enough for our family to enjoy it. My family is 6 and my dog can fit in it. We're close to everything. I want the experience, not necessarily the mansion. So it has to be kind of a middle ground to cater to a little bit higher end people, but not so high that it becomes that major burden, like you said.
So smart. And I love it. By the way, I want to just shameless plug for Anna, because I so appreciate her and the value she shares. REIMom.com, correct, is your community. So if you guys want to reach out to her and find out more, clearly she knows what she's talking about. And this is just one area of expertise for Anna, which is so awesome. REIMom.com. And if we have time, we can get to some of the branding stuff, because I happen to think that's pretty cool. I was recently, a friend of mine sent me, and I'll have to send it to you. I don't know if you've seen this. It kind of went viral on YouTube. It's one of the YouTube influencers went out to this property, some part of Texas. I forget what city in Texas. So this dude, who I think is an accountant, ended up buying 5 or 6 acres, like in the woods, somewhere in Texas. And he built these beautiful A-frames. So he built 6 A-frame properties around the lake. And he was talking about the numbers and all that. But one of the things he experienced was a month after opening up, Airbnb shut him down for whatever reason. I forget why. And he said that, that was an opportunity for him to say, hey, I'm vulnerable here, relying on these platforms. And he ended up creating his own version of Airbnb. Obviously, it's not as big as Airbnb, of course. But so now he gets all of his bookings through his own platform, which he owns. What are your thoughts on, that's always been a concern of mine, is, hey, if I rely on VRBO.com and Airbnb, what if something changes with their terms of service? What if the county I'm in change it? Like, there's always been things that have felt are outside of my control that can impact that investment. What are your thoughts, or where do you kind of land there?
Sure. So I think there's two kind of questions. One is the platforms themselves. And there's been a lot of backlash and concern in the last year or so, toward Airbnb, because pretty much the person that's renting is always right. They're always given refunds. They can complain literally. I saw a post of someone that they complained that there's spider webs on the hot tub, and they refunded their money for pests. Well, they're out in the middle of a mountain where spiders can build a web in a couple of hours, right? Mm-hmm. And so they basically said, well, unless you put in your listing that you're in the woods and there could be spider webs, then you're not covered if they find it. So it's kind of ridiculous, right? There's lots of stories of them shutting someone down because of one person's false complaint, and then they lose Superhost. They take all their properties off the platform. So what it should teach people is you should never just have one source of leads into your business, whatever that is, right? So I have my properties on Airbnb, VRBO. We have our own website for a couple. We have, we haven't used bookings.com yet, but that's another one. And so it is definitely a big lesson for everybody, no matter what our business is, right? Is that we need to have a way, whatever it is that we're offering, where we have a constant stream of marketing to reach those people, to let them know about us, and then a constant way to bring them in, constant way to take payments. PayPal's another one I think about. I have PayPal, but PayPal has shut a lot of businesses down because suddenly they don't know that some transaction isn't fraudulent and they can hold your money. And so I'm always thinking about risk, which was one of the things that you said that's really important in every aspect of every business that I have. If it's multifamily, it's like, what's the risk that I don't fill my property? What's the risk that my energy costs go up? What's the risk that cap rates come down, right? So I'm looking at every investment as, a pure fundamental of investing is I'm investing my dollars in something that I anticipate is going to create me a future cash stream or a future upside, a future value. And I'm paying a price that's supposed to take all of the different risks into account of not being able to reach that future cash flow stream or not be able to reach that future appreciation. So as an investor at heart, we shouldn't just be buying things because our friends tell us it's a great deal and a great place and stick it on Airbnb and you'll be fine. You always have to say, what are the things that can derail my pro forma or my projections or my returns? And let's mitigate as many of those things that are within our control so that when the things outside of our control, like a pandemic or, a recession or Airbnb shutting you down, if those things happen, I have plan B and plan C and already have kind of planned for the worst case and then build my systems and processes to protect myself as much as I humanly can. But you have to understand all the risks of your investment in order to really protect that investment, manage that investment, and yield the returns that you're hoping for.
There's so much wisdom that if I so want to encourage everybody listening to just rewind 2 or 3 minutes and listen to that short segment on risk, because it can save you so much headache, heartache, money, time. And I feel that oftentimes, Anna, and I don't know, I think you'd co-sign on this. Sometimes people enter investments and they're only thinking about the upside. They're only thinking about everything that can go right. And they don't spend any time or energy on like, hey, what can go wrong? And then to your point, if it goes wrong, how are we going to pivot? What's plan B? What's plan C? My partner and I were in the process of purchasing another storage facility in Northern Florida. And we're getting the last part that we need to nail down before we close on the 10th of October is insurance. Because this is literally 30 seconds from the beach, this particular storage facility, great location. We are getting quotes between $20,000 and $25,000 for insurance. And one of the questions I asked my partner and we had a conversation about was, hey, if next year we go to renew this premium and all of a sudden it's not 23 grand, but it's 30 grand, what does that do to our numbers? Like, what does that do to our cash flow? Right.
Right.
And does this still make sense? If it goes to 30 and we can't control it, how are we going to adjust? Do the numbers support an additional $6,000 or $7,000 in annual premiums, right? And we had to have that conversation. And so if it were to happen, I hope it doesn't, obviously, but if it were, we've already discussed how we would like approach that situation. So that's just an example.
It's so important. Yeah. Very, very much so. And I had something very similar when I bought these oceanfront properties that are in Pensacola, right? There's literally a hurricane. Right now, it looks like it's going to go to Tampa, but it could come as far west as Pensacola. And I have two brand new properties. I knew that my taxes could go up. A lot of people also underestimate taxes going up after they purchase a property at a much elevated value. So I assumed basically double taxes for the next couple of years after year one, tax reassessments. Yeah. I also knew that the national flood insurance providers were significantly repricing flood insurance, and I had oceanfront properties. So I estimated, okay, maybe my insurance costs go up 20% when I did my numbers. Because my cash on cash return was 19% on my oceanfront properties, I knew I had quite a bit of wiggle room. But I was shocked, Alex, last month as my insurance policy was renewing on one oceanfront property between Destin and Pensacola. My regular insurance, just the property, went from $8,000 to over $12,000, a 50% increase. Yeah, and flood insurance almost doubled as well. So suddenly that 19% becomes maybe 8%. Right? At some point, you have to say, is 8 worth the risks and the other risks beyond my control? And for me, the answer right now is yes, because I can weather it and I want to live there in a few years and I want to visit my son. But at some point, we've always got to be analyzing our investments up front to see if they make sense on a really conservative. I always run worst case. I talk about worst case and people say, oh, Anna, you think the sky is falling? I'm like, no, I don't. But I want to plan for the sky falling. And then I want to say, what would I do? And if I can, again, mitigate about 70% of the things that can go wrong, I'm willing to take that risk and buy that investment for the right return. Yeah. But you also need to look at your investments every year as you own them and say, are they performing as I thought they would?
That's right.
Are there new risks that I didn't anticipate when I bought it? And is the risk worth keeping the property if it's going to really derail, the future cash flow and the future upside that I thought I was going to have? And so, I buy and sell properties that I planned to own for 10 and 20 years because of new risks that suddenly make those returns not good enough for the risk that I'm taking.
So good, Anna. And we're taught to be good stewards of money. And I think an extension of that is being a good steward of your portfolio. One of the things that you alluded to was looking at your assets on an annual basis at a bare minimum and saying, hey, are they performing the way I expected them to perform? I love the question, what are the new risks that maybe I hadn't thought about in the past? Just because you buy a property, turn it over to a professional management, third-party management company, you don't just like turn the blind eye to it. You still got to look at it. You still got to make sure you nurture it, kind of like a baby. And you might not necessarily be in the weeds day to day per se, but you still have to manage the property manager, and you still want to overall assess the performance of that asset, and then ask questions like what you shared is, hey, what are the new risks coming up this year? What are we going to do in this case? Just so wise, a lot of wisdom in that. Last maybe 5-10 minutes here before we wrap up, I want to kind of transition to the state of the market. So we're recording this end of September 2022, just for as a reference point in case you're listening to this sometime in 2023. Not that we're holding you to this because nobody's got a crystal ball, but you alluded to earlier on in the show about the 2008-2009 crash and how you learned from that. What are some of the indicators, some of the things that you look for to kind of forecast, hey, here's what I think is going to happen in the next 3, 6, 12 months based on these indicators, I guess?
Sure. I'll try to be very brief. It's a very complex situation that we're in, right? But some of the things that I learned from 2009 that I take with me today, right, is really watch what's happening to the macroeconomic financial things that are happening that could impact my investment, right? One of those things, for example, is the interest rate. So we see that we have inflation and the Fed is committed, at least they're very hawkish and that they're saying we are going to kill inflation, whatever it takes. And they came out, Powell came out last week and said essentially expect rates to be prohibitive, pretty much restrictive through until early 2025. So what that tells me is if he's right and they're serious and they're going to elevate rates by the end of the year and keep them there, through 2025, I know that I need to look at my debt very, very carefully and say, whatever debt I select, number one, it better not be bridge debt or variable unless I have the wherewithal and the money to pay for an interest rate cap, right? Unless I can hold those assets a little bit longer to get through a period of increased interest rates and then, hopefully not have to refinance till they fall. So I'm watching interest rates very carefully. I've also watched over the last 10 years, we had the longest expansion period, meaning going from the bottom of the Great Recession to the top that we've ever had in U.S. history since President Abraham Lincoln was in office. Wow. So what I realized and what I didn't really appreciate back in 2008 was that essentially most investors have only been in this thing since 2009, right? Those that were in it before, it lasted, but most investors that have jumped in have only experienced, 12, 14 years of up, 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 up. And so you just automatically think you have recency bias. You think because it was good before, the Fed will fix it. And in a couple years, we'll be right back down to the way it's always been. Rates will be down, values will be back. When you look at things from a macro perspective, that's not necessarily true. If you look back at history, so I study the 1970s and the 80s and the 90s, go back to the 1940s and see what happened to real estate in the aftermath of some major financial event and how long did it take for values to get back to where they were. Well, we are just back at about 2020, 2021 with values hitting back where they were in, 2007 before the last crash in many markets nationwide. And so I am not assuming, I'm really optimistic about most things, right? But I'm not assuming that with great optimism and beer goggles or, rose-colored glasses that 2 or 3 years from now is going to look like it does today. I think there's going to be a lot of economic pain. And so I'm banking on going back to the fundamentals of doing only really great deals that can weather some hit to the income in whatever ways that might be, legislative risks, rent controls, people not vacationing, whatever it is, weathering rises in expenses if inflation stays high and still be able to service my debt. That's the most important thing right now. How much debt do you have? If rates continue to rise and don't go back, can you service that debt? Because asset preservation has to be your absolute most important financial goal in times of economic crisis or potential economic crisis. So I've learned to de-risk my portfolio. I sold a lot of properties and I'm a net buyer. I want to hold for a long time. But I saw we're at the top. It could be coming down. I'm going to cut my potential additional growth, take off the table what I have, and now have liquidity that I can service that debt, even if my tenants can't pay, my people don't come. And then I've got opportunity money sitting here that when the bottom does hit, we may see the best opportunity in our lifetime, at least best since 2009 after everything crashed. But you have to be prepared. So I'm preparing for a lot of pain, but I'm very opportunistic and excited about the fact that I'm in a much better position now because I studied the economy. I studied economic and real estate cycles. Because I was so burned, it took me over a decade to build out from 2009. I learned that this time I'm going to become a student of the economy as much or more so than I am a student of the asset class or the niche in which I'm operating. So if you don't understand the economy, don't jump into a new asset class that you don't understand the risks and how you mitigate risk and how you preserve capital first and foremost. The growth and the appreciation, if you buy right when everything hits the bottom or close, will come, but it could take a decade, right? So you just have to know you have to know what's happening. You have to do your best to hedge. Don't be so scared that you just back out, because holding cash is not a wise thing right now either. But I think that there's some pain ahead, but there's also tremendous opportunity if you're wise and careful.
Yeah. When I was transitioning from the single family wholesaling space and I was looking at different asset classes, I pretty much nailed it down for me to multifamily and storage. Both I could have gone in either direction, and I think they would have been a wise choice. I ended up ultimately going with storage because, similar to multifamily, they're not recession proof, but recession resistant, the way that you said. I looked at what happened to storage and multifamily in 2008, 2009. What happened in the early 90s. And so I think that's saying, if you're not a historian of the economy and you don't study what's happened in the past, you might be doomed to repeat some of the mistakes that people made in the past. Are there any particular resources, books, podcasts, blog sites, just anything in general because there's so much information out there. So for somebody listening to this that wants to act on your advice and say, hey, I need to become more educated about the economy and what happened in the past so that I can be a wiser and smarter investor moving forward, any particular places you'd kind of point their direction to?
Sure. It's really hard because there's so many economists that have different views. Some think that we're heading toward mass inflation and elevated inflation for the rest of modern history. And some think we're heading to mass deflation and really strong recessionary periods for the rest of modern history. So I watch a lot of economists, but one thing I do is I listen to a lot of YouTube interviews with investors who have run hedge funds, who are in their 70s and 80s, who have been through multiple the 50s, the 60s, the 70s, and they've been through multiple market cycles, but they've come out with wisdom on when this happened before. Here's the factors that caused it, and here's how we don't make that same mistake again. So I listened to interviews with Ray Dalio, for example. He's written a couple of really great book, Principles for a Changing World Order, Big Debt Cycles. He's someone I really listen to. Jim Ricards is another one. Jeremy Grantham is another one. Obviously, Warren Buffett is another one. So listen to their interviews on YouTube. I've bought a volume of volumes this thick of the history of the Federal Reserve. I've read books by Bernanke and Volcker, and looked at what is the Fed thinking and why do they continue to create asset bubbles and crash the system, and create asset bubbles and crash the system. What does debt do when you take too much on? So listen to YouTube. Wealthion is one particular show that I watch on YouTube it brings in a lot of experts who have a broad level of decades of experience dealing with money and currencies and debt cycles. And so that's probably the one that you can get caught up on the most, to kind of think about what are the things that they're seeing? And they all see major economic pain for the next decade, by the way. What are they doing to hedge? So, do that. If you're interested in following my posts on Facebook, I kind of try to break some of those things down, but that's where I would start.
I love it. Again, I'm going to have to see if I can somehow convince you or incentivize you to hop back on a third time at some point, maybe later this year, at some point next year, because there's so many more things I want to ask you, but I want to be respectful of your time. I want to just take a quick minute to recognize and acknowledge you again for being such a go-giver, for being a thought leader in our space, for just all the valuable content you put out. If you guys do nothing else but just follow her on Facebook, every now and then she just drops a lot of wisdom in her posts. And I learn every time I read one of them. And I had been meaning to get you back on here. I don't know how 2-3 years elapsed between the last one, but I sent you a message a month or two ago, and I'm glad we were able to make it happen again. So I'm going to flash this on the screen in case anybody's happening to watch this on YouTube. You want to spend a minute or two, talk about reimom.com?
Sure. Great. First of all, it's my pleasure. I'd love to be back on the show. Always happy to help people and, kind of navigate this economy. But yes, my brand, reimom.com, is where I provide coaching and mastermind opportunities for people that really want to learn about real estate and investing in general. I kind of marry my 20-something years in the financial world and retail investments with my 20-something years of real estate, and try to help you figure out where you want to go, how you navigate your wealth, and how you use real estate to do that. And then I have another website, which is greaterpurposecapital.com. And that's really focused on accredited investors who want to invest in multifamily properties where we really go in and make an impact on the community, create returns, but really focus on the returns of the people in the communities as well.
Fantastic. Well, I'm excited to continue to watch you grow and then now beyond helping people, not just people through your community, but also investors that you're working with that want to get involved in multifamily. So thank you, my friend. So appreciate you. And guys, really, I mean, there's so many. This is one of those shows I don't always recommend this, not because the other ones aren't great and fantastic in their own way, but this is one in particular I would say you're going to want to listen to multiple times because there's a lot of things that are so easy to have missed. And, you know, even if you're actively listening to this is one that I'm going to re-listen to because myself, I'm interested in acquiring an Airbnb in the Keys. And Anna, if it's okay, I may have to pay you and consult with you and see if I can extract some of the wisdom you have, particularly when it comes to Airbnbs and vacation rentals and all that. So thank you again so much for everything. And guys, I look forward to connecting with you on the next show. Have a great one.
Thank you.
Hope you enjoyed that episode. But before you go, you know, I've had a lot of people recently reach out to me wanting to learn more about Ascend, wanting to understand how the mastermind component works, how the coaching relationship works. And so right now we're actually on a waiting list. But what I would encourage you to do is if you think you're the right fit and you think you could benefit from being a part of our community, head over to ascendyoursuccess.com, watch the short video, and then just click the apply to join button below. And then we'll be in contact with you if and when a spot opens up. So really appreciate you listening to Flip Empire here, and I look forward to connecting with you on the next show. Take care.